In this last part of the course, we're going to be dealing with issues where we are changing our ownership in an asset. We're either converting it to cash or we're changing it out, swapping it for another answer. Prior to this, all of our kinds of income have been income that was either earned by the sweat of our brow in the form of wages or self-employment income, or things like interest and dividends, which are income we earn while continuing to own the asset. So now we're actually going to sell assets. That's going to potentially generate capital gains and losses. Capital gains have preferential tax rates. Capital losses have limitations on the ability to deduct. So we got three basic conversations here. The first one is how to compute gains and losses when you change your ownership in property. The second one is determining what your basis is. Your basis is determined by how you acquire property, and we have a lot of slides coming up to talk about that. The third thing discussed in this chapter is one that we're not going to deal with very much, installment sales. An installment sale is when you sell something today and you accept payments on an installment basis, which means that you collect the money over several years. Not much different than what happens in GAAP. I am not going to formally test you on this material. Instead, on tax return either 11 or 12, you will complete the installment sales form. You'll sell some land on the installment sales basis, and we'll take care of how we recognize the income. The short answer to that is you'll calculate gross profit and a gross profit percentage. And for every dollar you collect, when you actually collect it, you recognize income relating to that gross profit percentage. But like I said, we're not going to spend a whole lot of time on it. The nuances are pretty complicated and way beyond where we need to go. So I have here a gain and loss formula. It's basically the things that you need to consider when you have terminated your ownership in a piece of property and you're trying to determine whether you have a gain or loss. So the first thing's got to be the sales price. We have several slides coming up. In a simple situation, it's cash, but it could be cash, debt relief, property received, services provided. So what you actually get in the real world could be fairly complicated. From that, we reduce selling expenses. That are things like our broker's fees, anything you have to pay to trace title. They usually have a lot of little stamps you have to pay for when property changes hands. All of those things are part of your selling expenses. They directly reduce your sales price in determining the amount realized. So if we talk about amount realized, that's a term of art. Sales minus all selling expenses. And then we've got several slides coming up talking about what adjusted basis is. The net of that is your realized gain or loss. When I say realized, that's just the math, right? That's not necessarily what's going to impact your tax return. Some of your gains or losses could either be deferred or excluded. Deferred means you've simply kicked them down the road and they're going to come back to haunt you when you have a subsequent disposition of property. Excluded means they're gone forever and you don't get any benefit. You don't have to worry about them ever again. So the net of all that is the income that will be recognized in the current tax return. Recognized gain or loss will directly impact your taxable income. Okay, so this slide simply deals with the fact that laws change when you buy property. Laws change about how to depreciate property. So when you sell property, your determination of gain or loss, the actual dollar amount, whether it's a capital gain, whether it's long-term or short-term, and these are all things we'll talk about coming up, is determined by the law at the date of sale. So if you buy something in 2013, what you care about when you're going to sell it is any law that's in effect in the year you actually sell it. On the other hand, a lot of the things that you buy may be subject to depreciation adjustments. Buildings and equipment used in a trade or business or a rental. you depreciate them from the point in which you acquire them. So you use your depreciation rules that are in force at the time you acquire the property. If those rules change subsequently, you are grandfathered into the old rules and you continue to use the old rules. So back to amount realized, right? Remember, amount realized is sales minus selling expenses. And the actual amount net of those selling expenses will be the sum of any money that you get, any fair market value of property that you receive. Now, in the real world, determining fair market value is fairly complicated. There are mechanisms in play so that if you sell a substantial piece of property, both the buyer and the seller have to agree to how they have determined the fair market value, how they have allocated it to the different pieces that were in the sale. In our course, if I tell you the fair market value is X, you will simply use X. In the real world, if you're on a game show and you win that really ugly brooch, and they tell you that its value is $30,000, and you know that nobody would ever buy that brooch for $30,000, you can feel free to argue that the actual fair market value is something smaller, and that generally will be respected unless you get audited and the agent has strong feelings. The agent absolutely loves that brooch. They may not understand why you're discounting it by 30%. So fair market value sometimes is cut and dried. Other times it is a subject of negotiation. And then you add to that any debt relief. So if you sell some property that was subject to a mortgage and the buyer takes over the mortgage, that is the same as if they gave you the cash and you paid down the debt. So that is part of your amount realized. And then the last bullet here is the fair market value of any, no, I got it all done, is reduced by any selling expenses. So it's money, fair market value of property received, any debt relief received, minus any selling expenses, get you to your amount realized. Adjusted basis, that is the amount of the original cost of the asset that you have not recovered at the date of sale. And so the easiest one is you just paid cash for it, and that would be what you paid for it minus any cost recoveries from Part 3 that you were able to deduct. You would increase for any improvements. Remember, improvements are the things that extend the natural life. The GAAP and tax concept here is pretty much the same, right? To paint your building is a repair. To replace the roof is probably an improvement. And so there are lots and lots of cases out there where people have made different arguments. If you have a gravel driveway, re-graveling the driveway is just a repair. If you decide to turn it into an asphalt driveway, that would be an improvement. So when in doubt, there's probably somebody who's gone before you, and you can find a court case or a revenue ruling that will distinguish between the improvements and the repairs. So I don't remember if I have used the term recovery of capital doctrine before, but I'm going to use it a lot here. When you buy property for the purpose of making money, and you subsequently dispose of that property, you have the right to recover what you spent before you have any gain or loss. So recovery of capital doctrine means if you spent money to make money, you've got a right to take a deduction for that money that you spent. So that's why when we get our gain or loss formula, it's our amount realized minus our adjusted basis becomes our gain, right? So we get rid of any cost we have not yet recovered before we even begin to talk about what our gain or loss is. And so we're going to have several slides talking about determining the cost basis. And the cost basis factors I've already alluded to. That's the cash, the services, and the debt relief. But we'll spend one more slide on that. And then we'll talk about what happens if grandma gives you property and you subsequently sell it. What is your basis in that property going to be for determining your gain or loss? And then we'll have situations where grandma kept it until she passed, And so that's property acquired from a decedent. So this was inherited property. You got it after somebody died. Those rules are different than the ones if they choose to give you the property during their life. And then sometimes you have something that was originally just your personal stuff that you convert to business use. Your car and your computer are the most common examples. Sometimes people take a home, convert it to a rental property. So all of those would be things that you originally purchased just to use for yourself that you later converted to business property. And there's a rule for determining what your basis would be at the date of conversion. So how you require property determines part of the basis adjustment, whether you purchased it, whether it's a gift, inherited, or converted. So just a quick review of what we've already said. If you buy property, your basis is the cash or fair market value of property given up. All right, so we're looking here at your giving up property. You want to buy my business. You're going to give me some cash, but you also say that I will prepare your tax return for the next 10 years if you sell me this property. You've got to determine what it's worth, what your services are normally charged at when you prepare someone's tax return. And you've got to come up with a good, solid estimate of what preparing tax returns for 10 years is worth. And you can include that as part of your basis in this property. Any debt you assume, because remember, debt relief is part of the amount realized for the seller. As the buyer, assuming debt gives you basis. And in the last set of slides, we talked about how you have to be at risk for your debt. All right, so non-recourse debt will not give you basis because non-recourse debt gives you the right to walk away from the debt by simply returning the property. And then non-deductible improvements. Non-deductible means simply that we deduct repairs, we capitalize improvements. And that can be a really messy line, right? Putting 5 shingles on your roof is probably a repair and you deducted it. Replacing the entire roof is probably an improvement because a new roof will extend the life of a building. Putting in 30% is somewhere in between. And so if you do a partial replacement of your roof, you're going to have to be careful and check your facts to determine whether this is an improvement or a repair. In our simple little world, I'll simply use the words repair and improvement. You will expense repairs. You will capitalize improvements. And you will actually only expense repairs if it's business property, right? Because if you repair your personal residence, that's just a non-deductible personal expenditure. It's only when you add the bedroom or you add the trees or you add the swimming pool that you have improvements which would add to the basis of your personal property. So now we're going to talk about what happens if people give you property. This is not your employer, right? Your employer, if your employer gives you something that is in return for your having worked for your employer, right? He may like you, but he doesn't give you things the same way Great Aunt Betsy gives you things. So if your employer gave you something, that would be part of your wages, and you would have to figure out the fair market value of what you got. And that, for the most part, would be the wages that you received. And so that would be in your W-2, and your basis in what the boss gave you would be the fair market value or the amount included in your W-2. Here we're talking about Grandma and Great Aunt Betsy. All right, so we're going to use some abbreviations so these slides don't get too cluttered. D is the donor. That's Great Aunt Betsy or Grandma, the one who's decided to give you something. Right? They're giving you something because you're cute, not because you mowed their lawn or you repaired their porch, but because you haven't done anything, but you're just a nice kid, right? The donee is you. You're the one who is receiving the gift. And then the date of gift, or what I call the dog, that's the date of valuation for most of the things that are happening here. So when you get a gift, at the date of gift or the dog is when you do most of your evaluation computations. So our general rule is if it is appreciated, If the fair market value is greater than basis at the date of gift, you're going to get the basis. All right, so an important thing to understand here is that special tax rates on capital gains, which we will discuss in the next set of slides, did not exist until just a few years ago. So for the most part, when people had a capital gain, especially a long-term capital gain, everybody paid taxes at about the same rate, right? It was very hard to do bracket shifting with long-term capital gains. So the government really didn't care whether grandma recognized the gain or junior recognized the gain. So it's very easy for you to pass on your capital gains, allow them to be recognized by the donee. Government doesn't care, right? Now, nowadays, the way the rules work, and we'll see in the next set of slides, if junior is in a 10 or 15% tax bracket, he will actually get a 0 tax rate on his capital gains, because long-term capital gains work just like qualified dividends, but the tax code was never modified to care. So grandma has some good tax planning here. She could sell an asset, pay taxes at 15 or 20%, give junior the net proceeds, or she could just give junior the stock. Junior could recognize the full gain, pay taxes at 0, and keep 100% of the money. All right, so the tax code has never been adjusted to say that is not a good thing. On the other hand, losses have always been very difficult to use. When we move to the next set of slides, you're going to see that if you are unfortunate enough to net negative with your capital gains and losses, there are some severe restrictions on your using those losses. So there's a presumption in the way these rules are worked that if you were to give away property where the reverse is here, where basis was actually higher than fair market value, the primary reason why you were giving that was to shift the losses to a family member who could use the losses. So we've got a lot of slides coming up to talk about this. So what I want you to note for now is that if our math was flipped, if the basis was higher than fair market value, we have a whole other set of slides to consider, because the government will not let you pass your losses to your donee. They'll let you pass your gains, don't seem to care there at all, but they will not let you pass your losses. So the next couple of slides deal with passing your gains to your donee at the date of gift. All right, so we are allowed to pass our gains. So we start with, if grandma's basis was 1,000, then junior is going to start with 1,000 for his basis. If he immediately sells the property, he will recognize all the gain that grandma was going to recognize, but he'll pay taxes potentially at his 0 tax rate, because he has very limited income. He has not left the 10 and 15% tax brackets. But you see here, there's an and. All right, so there is another set of rules that we haven't talked about, and that is the taxes on transfers. And we're not going to spend much time on this. I just want you to know it exists. Back when this country was founded, I remember all the way back, one of the reasons why a lot of people came to America, they left the old world, was because the system that existed there kept all the wealth in the hands of a few people, right? When a rich guy died, his son took all the property, right? His oldest son got everything. And so a wealthy person was able to pass on 100% of his wealth to his firstborn male child. And so that didn't give much room for diversity. So when people came to the United States, and transfer taxes existed long before income taxes, one of the desires was we want to break up some of that wealth at the top. So one of the principles that have always been part of the U.S. tax system, all phases of it, is that we do take money away from the richest people and we give it to the poorest people, right? We give it in the form of tax relief, welfare payments, food stamps. And so way back at the very beginning, we had a set of rules that said if you die, your property gets taxed as a transfer tax or an inheritance tax as it moves from dad to son, so that the government's going to keep a percentage of all the rich people's estates and use that money for other things. So then people said, well, I'll just give it away before I die. If I give it away before I die, I don't have to pay an inheritance tax. And so the current transfer tax incorporates both gifts during life and inheritances at death, right? And so if you are a wealthy person, and it's pretty wealthy, right? Because about the first 5 million or so, and it can be higher if it is your business income, is protected from the transfer. So most people will never pay a transfer tax because they just don't reach those levels. But Bill Gates and the way the Obamas are going, certainly Donald Trump, all of them will die with more money than the basic exemption for gift and inheritance taxes. And so they will pay taxes as they distribute out their wealth to their decedents, which is the way our U.S. tax system was designed from the very beginning. So the inheritance taxes were there forever. And then around 1913, we added an income tax. And now it turned out that you were going to pay a transfer tax if you gave something to your son. And then your son was going to take your original basis and pay taxes on all of the gain that you would have paid in your own tax return. And somehow that doesn't seem quite right. And so as the code was evolved and developed, what they developed was this next bullet, right? So if the donor, if grandma has to pay gift taxes, and remember our current system, they don't pay them until they've made a lot of gifts. If they have to pay gift taxes, a portion of those gift taxes, described on the next slide, becomes part of Junior's basis. So let's move there and see what that looks like. So remember, if fair market value is less than basis at date of gift, we are on a separate set of slides because we cannot pass our losses directly to our inheritors. All right, so the adjustment for gift taxes is pretty simple, right? The donor is going to pay the gift taxes. You may remember back from chapter 5 that gifts are not income to the recipient, to the donee, to Junior. This is absolutely true. But if the donor is a fat cat making lots of gifts, the donor may be paying gift taxes and when they reach over the basic exclusion. So remember, gift taxes are always based on fair market value of date of gift. The gift tax rules don't ask you whether it's gone up in value or down in value. They simply say, what's its fair market value? How much have you given prior to this? Are you over your exclusion? If you're over your exclusion, you get to pay taxes on this gift. Give the government the money. So the adjustment to the donee's basis, that's Junior's basis, gets larger. Because remember, he's starting with grandma's original basis, and he will get more only if the fair market value is greater than the basis at the date of gift. So that's our basic rule. All right. The reason for that is, you can see that the donee is getting gift taxes relating to the appreciation. So there's some logic here, right? The donee is going to get regular income taxes on the appreciation, the difference between grandma's basis and fair market value when he sells it. So what we're allowing him to do is increase his basis by the gift taxes that relate to the amount that he will pay income taxes on. So we have a little formula here. You take the fair market value minus basis, and you divide it by the fair market value, and that's the percentage of the gift taxes that will increase Junior's basis. So here's a mathematical example. At the date of gift, grandma's getting ready to give it to you. It's worth $17,000. Now, I haven't talked about the fact that each donor is allowed to exclude, has a non-taxable gift. When you get ready to take the CPA exam, that statement actually means something, right? What is a non-taxable gift? Well, we're not talking about the income taxes here, right? Because we already know that gifts are not income taxes to the recipient, but we do know that on the right set of circumstances, gifts do create a gift tax to the donor. So a non-taxable gift is a gift that grandma makes that's automatically 100% excluded from gift taxes. And I believe right now the rule is that grandma can give anybody $13,000 and not have to consider that as part of her taxable gifts. So the first $13,000 she gives Junior is a non-taxable gift and is eliminated from everything we've been talking about. So when we go forward, every example, quiz question, test question I give you, we will already have given our non-taxable gift to Junior. And what we're talking about is the amount in excess of the non-taxable gift. So when you see non-taxable gift, when you're studying for the CPA exam, that simply means that's the amount we carve off and ignore completely. So we've already given Junior $20,000. So we were over the non-taxable gift. We're giving him an extra gift here. Fair market value is $17,000. Grandma's basis is $1,305. So we know that Junior's going to start with $13,500 as his basis if gift taxes are paid. And a lot of times, remember, they're not paid, right? Most of us who are listening to this tape, who are in this class, will never pay gift taxes because we're not going to die with more than $5 million worth of stuff, right? Easily for me, I guarantee you. And so I will never reach the full gift tax and inheritance tax exclusion. And so I may have to fill out a tax form, but I will never owe a gift tax. So in our problems, I will simply tell you what the gift tax was that was paid. You don't have to worry about where that number came from. You just say, oh, yeah, the facts must be right. They must have actually paid a gift tax, and the amount must be what's ever here. So in this particular case, Grandma had to give the federal government $2,000 because she gave Junior this gift. And gift taxes are really high. Very quickly, they get to 50%. Because remember, the purpose of the gift tax and the inheritance taxes were to break up the big wealthy families. So they're pretty ruthless here once you go over the exclusion on keeping a really big hunk of every gift, of every inheritance to fill the federal coffers. So what we're going to do is Junior is going to start with $13,500. We're going to also give him the percentage of the $2,000 of gift taxes that relate to the appreciation. And appreciation is the gain that Grandma would have recognized if she would have sold it. So we're going to start with $13,500. We're going to add to that $412 worth of gift taxes. So what I said was the $2,000 times the appreciation over fair market value. So take a second and see if you can come up with that before I show the next couple of bullets. So the appreciation over fair market value times 2,000 will equal 412. All right, that's the formula again. Fair market value minus adjusted basis, that's the appreciation. Appreciation is the same thing as the gain that would be recognized, assuming there were no selling expenses, divided by the fair market value. So the gain itself, you can see, would have been $3,500. 17 minus $13,500 divided by 17,000 times 2,000. That what gives us the 412. So the donee Junior's total basis would be $13,912. You will get a guaranteed question on this one, so make sure that it makes sense to you. The homework in the book is really clear. It's clean here. It's a good place to go back for reinforcement.